Hello and welcome to the market update for March 3rd, 2020. Jeremy Fehr here, and today we're going to take a look at the impact of the recent market drop on coronavirus COVID-19 fears. The first chart we're going to look at is our equity action call. As you can see in the far right side here, on February 25th, we moved from the top of the green zone at 100% down to about 79% on this equity action call. This weakness comes on the strength of commodities. Commodities moved up recently, as well as obviously the equity downturn that we've seen. For our purposes, though, we remain in the green zone and we continue to remain 100% invested in equities at this time. Our asset class rankings, our second level of analysis, has seen a number of changes over the last few updates. If we go back to October 22nd, Canadian equity and U.S. equity were our top two asset classes. We see in January 14th, our last update of 2020, that U.S. equity had moved above Canadian equity, but more importantly, international equity had moved up from the 6th position to the 3rd position. What we see as of the close this previous Friday is that U.S. equity remains our number one asset class, but commodities have come all the way from the basement, from the 6th position up to the 2nd position, largely on the strength of precious metals, and we see Canadian equity and international equity lose one level, moving down to 3rd and 4th positions respectively. So at this time, nothing is panicky, but if we have new purchases, the only place we're going to be looking at from the equity side is going to be U.S. equity. Our first chart we're going to take a look at is our SIA charts market equal weight index. This index is an equal weight basket of U.S., Canadian, and international equities. It pulled back over the last week under the COVID-19 fears, and we can see in the top right here we've got 5 O's down from the top. So given the veracity of and speed of what we saw for a decline last week, I think many people would have expected to see this chart look significantly weaker than it does. But what we do see is that one level of support was taken out, so we took out a level of support. We are currently sitting one box above the second level of support that we are looking at that 64,330 level, and we are now range bound between the top at 72,446. We see of modest concern at this time is that the S-Max is a 5. We consider that short-term negative, so this suggests that there may be near-term weakness in it. But what we really want to watch for here is whether or not we take out that support and reach that 63,068 level. But on a chart basis, we sent out a piece here over the last couple of days highlighting on the SIA market equal weight index the number of times that we've seen 5 O's or greater going back to the bull start in the early part of 2009, and there's at least 10 of those times where we've seen this. So on a percentage basis, we're not extremely concerned. It was just the speed that it happened, and obviously some emotional concerns given the COVID-19 scare that remains today. The next chart I want to look at is the same chart we just looked at, the SIA market EWI, but in this situation we want to compare it to our SIA bond EWI. So what's interesting about this chart is that we see the S-Max remain 7, so that suggests that we should still be bullish on equities on an equal weight basis. That chart, overall equity still remains stronger than fixed income at this time, and we did see bonds rally over the last week under the pressures of the decline. We do see in the chart in the box that's shown up in the top right that we're at the bottom of the range. This is a range that's been sitting around since the mid part of 2018, and we nearly broke out of that before this COVID scare. So we've seen some consolidation where equities on an equal weight basis have been performing in line with fixed income since the mid part of 2018. So we've got a green dot and a red dot. This is where we're going to focus our attention. If we end up hitting that red dot, we've still got some room to the downside. We can see if we look a little bit further back in that 2016 time frame, you can have drops in these charts that can recover, but that would be our first sign of trouble looking at the chart as it sits today. The next chart we want to look at is our SIA market equal weight index versus the SIA commodity equal weight index. I wanted to put this chart in because we've seen very good strength in commodities, and it's really been a narrow rally with that. It's largely been metals, and specifically precious metals. Gold has done extremely well over the last little while. We saw commodities move up in our asset class rankings to the second position. So that has not happened in some time. I'm going to have to go on memory here, but I would suggest that that's nearly a decade old since the last time we saw commodities in the second position. So that is material, something that we're watching closely. If we look at this comparison chart in the top right in that box, we can see that there has been short-term weakness in equities versus commodities. That has started just over the last number of months. In June of 2019 till now, their commodities have been strengthening, but we still see on a longer-term basis the uptrend is in place, and even on our shorter-term SMAX, we have a 6. So it's one level above where we might expect some weakness. But again, what we're going to watch here is those red and green dots. If we hit the red dot, we still have a couple of levels of support below that, but we'll watch that closely. Just at this time, we're not dramatically concerned about this chart. The next comparison chart I wanted to look at was the SIA market EWI versus SIA cash. This is a very important chart because this is going to highlight if large pools of capital are really moving away from equities and looking for short-term treasury options to put their assets in fear of a significant global crisis. So this is one that I watch very closely. We can see the SMAX as a 9 remains still very much in favor of the SIA market. The uptrend remains in place. What's interesting about it, though, is that cash has done very well. We've been in largely a consolidation pattern shown by the rectangle in the top right corner, going back into the 2017 time frame. So that's quite significant. A couple of drops below that, that would be our 2018 and 2016 scare. So we would love to see if we're bullish on equities, and we do remain in the green zone of the equity action call, for the green dot to be touched, not the red. And again, if it hits the red dot, we still have a couple levels of support, but it really highlights since the mid part of 2017 how much index-based rally we've seen. You know, the FANG stocks and the mega caps have really led those cap-weighted indexes. It has not been on equal weight basis until recently when we saw a rally post-Christmas of 2019. We did see that rally. So hopefully that's something that we'll see coming up. We'll watch this chart very closely to see. But again, nothing in this chart is going to get us overly panicky at this time. The next chart is the SIA U.S. Equity Equal Weight Index. Again, not dissimilar to what we saw on the broader-based market EWI. We saw a very strong uptrend post-Christmas. Around that Christmas time, we saw the breakout and moving up very, very strongly, and now reversed down. So we've got 6 O's on this chart. We've seen that a number of times, but what we are most concerned about this is the SMAX is a 4. The chart itself still remains in an uptrend. We're not overly concerned about that, but the near-term weakness that's showing up on an equal weight basis in equities is something that we'll watch. I don't have the chart up here today in a point figure chart, but if we looked at the S&P 500, that SMAX score is stronger. It remains positive, which indicates that the sell-off that we saw over the last week was more broad-based, and that the mega caps were not being affected as strongly as the broader market. So that's something we got to watch moving forward. But again, we've got support nearby. We'll watch to see if that breaks down before we're concerned. The next chart is the NASDAQ. So this is, I believe, the only cap-weighted index that I've got in our charts today. But I did want to point it out, and it does highlight, if you look at the SMAX score, still a 7. The S&P 500 is very, very similar, but the NASDAQ has held up much stronger than the S&P 500, has held up much stronger than the TSX Composite, and has held up much stronger than the international indexes that are out there. So it's good to see this. It has been our leader. It is good to see our leadership remain in place. A strong bullish pattern that happened in December, where we saw a breakout, an extremely bullish pattern, which produced some pretty strong returns right away. We've seen a reversal of about 2/3 of that movement up. We would probably think in normal market conditions, considering how overbought this index is, that a 50% retracement would have been sufficient. So certainly the COVID-19 scare has hurt it a little bit more than we would have expected. But short term, again, everything looks positive, and we do have support nearby. So another chart to watch, nothing to hit the panic button. It remains a correction in the context of a bull market, just like the other charts that we've looked at earlier. Canadian equities have suffered in line with our U.S. counterparts. We're looking at the SIA Canadian Equity EWI here. They have benefited a little bit better in recent days based on precious metals and obviously the larger exposure to metals and precious metals within the Canadian marketplace. That's helped them out. We do see a 4S max. That is weakness. I think it highlights also that Canadian equities have been under pressure from other political issues that may be in the marketplace right now. So we did see weakness even before the COVID relative to what we saw in our U.S. counterparts. So we're watching this one closely. We're reaching support levels are just there, just like most of the charts we've looked and examined at today. But again, we wouldn't be hitting the panic button right now. We are in a bullish overall trend since 2016. Obviously, Canada has been consolidating, as you can see in this chart, much longer from 2011, largely based on its expectancy that commodities will do better, and commodities have not over that time frame. The U.S. dollar, Canadian dollar, we can see what is different from our last update in January is that U.S. dollar has rebounded a bit. We've got 3 X's on the chart moving it up, so it's got some resistance above in the 136, 137 range. We've got an S-max that is slightly negative, so it's more neutral, but we did see some money flows moving into U.S. dollar over the last week and change as large pools of capital look for the safest places to hide, and obviously the U.S. Treasuries do a great job of protecting. So we're looking for a move above 137, would be expected to be on bullish. It's interesting to see both U.S. dollar and gold rallying at the same time. So these are clearly places people look to for safety, and we'll continue to watch that for any weakness that we might see in the U.S. dollar, which might indicate that we're back, moving back to where the market was just a few days ago or a week or so ago. The Fed cut today came out 50 basis points. We did see U.S. dollar rally on a near term, so clearly that rate cut was priced into the U.S. dollar already, and I believe the expectation is for another 50 basis points before the end of the year. So the U.S. Fed is moving more aggressively than other markets on interest rate policy. We'll see if Canada and the rest of the world follow suit. Crude oil is a really, really rough chart. Certainly was under pressure already, declining strongly before the COVID scare. If we look back, I believe we were in that $58, $57 range when we did our update in January. We're now down into the $45 range, and we've gone from the low 50s down to that $45 range on the weakness from COVID and this expected declines in consumption from air travel and automobile travel and shipping, et cetera, was expected to decline. OPEC and Russia have done some minor cuts. We're expecting to see more from them. The chart still remains weak on crude. Any, I think, effect of those cuts would be slightly material to the chart. We would expect resistance to be fairly strong in that $49, $50 range. We really have to watch this for that $41, $40 breakdown from there. So that'll be an interesting support level to watch on crude. The last commodity chart we're going to look at is gold, the exact opposite to what we're seeing with crude oil. It did have some weakness in the recent downturn. We did see a few percentage points come off of it, nothing to get us into a column of O's. We saw the strong rally yesterday and today in gold and remains extremely strong. So this is a very, very bullish chart, 10S max. It's got some resistance levels above that 1715. I wouldn't expect it to be a strong resistance level. It really comes down to those highs that we saw in 2011 in that $1,800 range. So it'll be interesting to see what happens with gold. Obviously, there might be some central banks that would have an interest in reducing maybe some of the expectations of gold prices. We'll see if that comes into effect. But as it sits right now, precious metals, specifically gold, have done extremely well and seem to be a place where everyone's placing. And you will see some more precious metal stocks in the portfolios at SIA Wealth right now. The last chart I wanted to hit really is just a view of what we've seen On a longer term basis, I'm using a line chart on this. It's just something I don't commonly do, but I wanted to show the S&P 500 and show the trend line that goes back here right to about 2011. You could follow this back largely to that March of 2009 lows on the index and largely world indexes at that time. We still remain above trend. You can see in the top right corner there has been a decline from this COVID scare, a slight rebound yesterday, rebound in Canada today so far, the last time I looked, and weakness in the U.S. But overall, the downturn that we've seen is still in the context of a bull market. So I want that to be clear from this call today, that we should not be in the panic button. We should talk to our clients and make them aware that, yes, this was extremely rapid. The speed and velocity of this decline was fast. That is to be expected with a universe, a world that does work on computer trading and high-frequency trading, does have that ability to move markets down significantly better and faster than we've seen in previous downturns. If you look at that 2018 downturn, you can see that the more recent one was a bit faster, but it was not explosively that much faster than what we've seen. So we shouldn't be overly concerned. We've got a lot of charts that we've highlighted here today that we can watch and can tell us if we are moving into more negative territory. The equity action call remains on green, so you want to still remain overly weighted in your equities. When we're looking at equities, we do want to be a little bit more laser beamed in them. So we want to focus on those investments that are in the right sectors, the right ETFs, right mutual funds. We want to really focus on that. So we've done a good job. If you look at what we've done at SIA Wealth over the last little bit in the downturn, year to date, yearly and 3-year numbers have been extremely well. So I would recommend taking a look at those if you have some concerns. And also keep in mind that should this worsen, if we move to the yellow zone into the red zone, those products can all move to short-term money market vehicles to protect your clients' money. So we're not immune to downturn. We're not going to try to time the market in those sub 15% declines, but to date we can at least have some assurance that this looks like it's just in the context of a bull market, and we will certainly notify you if we see worse from there. So with that, I'm gonna tie it off. We'll just take a look at our disclaimers here. And if you have any questions, we're always available. Myself and the team at SIA Wealth are here and available to talk to you if you have any questions. Take care.